Welcome to Breaking News to Trading Moves. Today we're going to break down a recent headline about Nike, ticker NKE. We want to look at their latest quarterly report and then chart out what that might mean for a bunch of other companies.
Right, because a report like this from a company that big, it never just affects one stock.
Exactly. And on the surface, the headline was a little confusing. Nike actually reported quarterly revenue that was a bit above what Wall Street was expecting.
Which is normally a good thing.
You'd think so. But that one positive was, well, it was completely overshadowed by some deeper worries about their profits and especially their performance in China.
And that's why the stock sold off.
Yeah.
Hard, despite that top-line beat.
So let's start there. What was the good news before we get to the bad?
Well, the good news is simple. That revenue beat, even a slight one, it does show that demand for the product is still there. People still want to buy Nike stuff.
The brand is holding up.
The brand power is there, yes. But, the market is forward-looking. And it moved past that validation really fast to focus on three main problems.
Okay. What was number one?
First, and this is probably the most painful one for the outlook, their gross margins fell. Again.
Which means they're not making as much profit on each sale.
Precisely. For a premium brand like Nike, that suggests they're relying on promotions and discounts to get products out the door. They're losing some of that pricing power.
And that kind of discounting pressure, that's not just a small seasonal thing, is it? It feels like it points to something bigger.
It does. It suggests the consumer's really looking for value right now, and Nike has to use price as a lever to, get them to buy.
Okay, so that was the margin problem. What was the second big headwind?
The second was the sharp drop in sales in Greater China.
Ah.
Yeah. I mean, Nike is often seen as a proxy for how the global consumer is doing over there. So a decline like that, it raises red flags about spending power across the board in that region.
When a giant like Nike slows down in China, it makes everyone with exposure there a little nervous.
It really does. And then the third concern was all about the future. It was in their guidance.
What did they say?
They flagged some real cost pressures coming from tariffs and sourcing, which, just makes that margin problem even worse.
So costs are going up while they're having to discount more. That's a squeeze.
That is the squeeze. And because of that, they guided for a slight revenue decline next quarter. And you have to remember, that quarter includes the holidays.
Oof. Forecasting a dip during your most important selling season.
Investors do not like to see that at all.
Okay, so let's map this out. If the biggest brand in the space is dealing with margin compression and weakness in a key market, that creates openings for some and problems for others. Let's start with the companies that might actually benefit here. The first group seems to be athletic retailers and wholesale partners.
Right, so think about it. If Nike needs to clear out inventory and move product, they can't just rely on their own website and stores. They often lean more heavily on their wholesale network.
So they're pushing more product to their retail partners.
Exactly. And that sends goods and probably marketing dollars to those partners. We're talking about companies like Dick's Sporting Goods, ticker DKS, Foot Locker, which is FL, and Academy Sports and Outdoors, ASO.
And how do they benefit? Is it just getting more shoes to sell?
It's more than that. It's a stronger product flow, maybe some increased marketing support from Nike itself, and most importantly, it drives foot traffic.
But hold on, if Nike is giving them product that's already being discounted, doesn't that just squeeze the retailer's margin too?
That's a fair question. The win for the retailer isn't always about a huge margin on the Nike shoe itself.
So what is it?
It's the traffic. A big Nike promotion gets someone in the door of, say, a Dick's Sporting Goods. And while they're there to buy those discounted sneakers, they might also grab a water bottle, some socks, or maybe a jersey from a totally different brand.
Ah, so it's about the total basket size. They win on the surrounding sales.
That's the play. It's a volume and traffic game for them.
That makes sense. Okay, group number 2 in the winner's circle. Challenger footwear and performance brands.
Yes. When the category leader is sort of forced to play defense and clear out inventory, it's a perfect moment for the alternatives to go on offense.
They can focus on their brand story instead of the discount rack.
Exactly. So here we're tracking tickers like ONON for On Holding, also DECK, which is Deckers, and SKX for Skechers.
And what's their angle?
Well, take On Holding. They have this really strong momentum in specialty running built on technology and brand image. While Nike's seen as having to discount, On can maintain its premium pricing.
And Deckers.
Deckers is interesting. They have two completely different powerhouses, right? UGG and Hoka. Both seem to be kind of insulated from the specific pressures Nike's seeing in, say, lifestyle apparel. They can just keep taking up shelf space while Nike is busy managing inventory.
But I have to ask about valuation with some of those. A company like On, for example, trades at a very high multiple because of its growth story.
It does.
So if the whole athletic market slows down, which the Nike report might be signaling, doesn't that make those high-growth names more vulnerable?
That is the critical point for you to consider as an investor. You're right. Their high valuations assume that rapid growth continues. If the slowdown Nike is seeing starts to affect everyone, then yes, investors might rethink those growth assumptions.
So for now, the story is they're gaining market share, but there's a macro risk.
Correct. The current narrative favored the challengers, but that could change.
Okay. And our third winner category is maybe a more obvious one, the off-price and value retailers.
This group is the natural winner in any big promotional cycle. All that discounted inventory has to go somewhere.
And its destination is often the off-price stores.
It is. We're talking about TJX, Ross Stores,
Hmm.
ticker ROST, and Burlington, BURL. They get better access to really desirable branded products at attractive costs.
They turn another company's overstock into their opportunity.
That's their entire business model. And on top of that, if consumers are more price sensitive in general, as the Nike report suggests, well, more people are going to be walking into their stores to begin with.
Right. So now let's flip it. Who's feeling the pressure from this Nike news? The first group is pretty clear. The other athletic apparel brands. The direct peers.
Yeah, this is the most direct connection. You're looking at tickers like UAA for Under Armour and VFC for VF Corporation.
And the logic is if Nike is struggling with margins, everyone else probably is too.
That's how investors often see it. Nike's margin decline is treated like an industry-wide data point. It says that competing for customers right now is expensive for everybody.
Especially for the smaller players.
Especially. A company like Under Armour is much smaller than Nike. They have less room to absorb that kind of margin hit. So it can lead to investors lowering their earnings expectations for the whole group.
The market basically looks at Nike and says, if the king can't protect margins, how can anyone else?
Pretty much.
Okay, the second group facing pressure we touched on earlier. China-exposed U.S.-listed consumer brands.
This is that bellwether effect. Nike gives this clear window into the Chinese consumer spending habits. And when they report a sharp sales decline, it's not just about sneakers anymore.
It's a warning shot for other brands that rely on that market.
Yes. Traders immediately start looking for other companies with that exposure. You see tickers like SBUX for Starbucks, YUMC for Yum China, and even AAPL for Apple.
They're all in different businesses, though.
They are, but they all depend on people in China having money to spend on non-essential goods. If Chinese consumers are cutting back on Nikes, the question becomes, what else are they cutting back on?
It's the uncertainty that creates the pressure.
It is. It just casts a shadow.
And finally, the third group feeling the heat. Import-heavy apparel brands exposed to tariff and cost pressure.
This group faces that really tough combination we talked about. Their costs to bring goods into the country are going up.
At the exact same time, the consumer is demanding more discounts.
A very tough spot. These are companies that are really vulnerable to global sourcing costs. We're talking about LULU, Lululemon, RL for Ralph Lauren, and PVH for PVH Corp.
Lululemon has always had amazing pricing power, though.
Historically, yes. But if their costs are rising due to tariffs or sourcing, and the overall retail environment is screaming value, it gets very, very hard to protect those high gross margins. You get squeezed from both sides.
So to pull it all together, this one report from Nike gives us a map. We see potential winners in 3 areas: wholesalers, challenger brands, and off-price stores.
Right, and then we see pressure on 3 other groups. Nike's direct peers, anyone with big China exposure, and import-heavy brands.
And the central theme here seems to be profitability versus demand. Brands are having to choose one over the other.
That's the core tension. They're sacrificing margin just to keep the volume up.
Which leaves us with a final thought.
It does. I mean, considering this pressure point, this value-seeking consumer we keep talking about, the question for you to really think about is, where does pricing power even exist anymore? If the biggest, strongest brands are giving up margin for sales, what parts of the retail market are truly safe from these cost and discount pressures right now?
A compelling final thought. We must remind you that this conversation is purely based on the opinion of the author of the material we reviewed. This is not financial advice or buy or sell recommendations.